They treat it like a transaction. They don't look at it long term as, this is all relationship business. I personally only want to get involved with people that want to get involved with me and we have aligned interests and we're doing this for the long term. It's not a one and done. We're in it for the long haul.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today we're joined by returning guest Scott Kidd, fund director behind development projects in the commercial space, founder of Yachty Real Estate Investors, blending high-level business with lifestyle and access. He brings a unique mix of capital strategy, development execution, and experiential branding. Welcome back to the show, Scott.
Hey, great to see you again. I'm glad to be back. It's just been it's always a lot of fun coming and talking to you.
We were talking in the green room about the bottleneck that a lot of people face in this space being, well, how am I going to raise more capital? That's, a huge issue for a lot of people, syndicators, fund managers, and then folks who are doing a lot of deals.
Yeah, it can be. I'm a big proponent of, finding a great deal is a big part of it. But you also need to maintain making those capital relationships at the same time. A lot of times you have to make sure that the deal is in alignment with the people that you're talking to.
Now, in this market today, who do you think is someone who is best positioned to be working with investors and raising capital? Is it someone themselves who has a big real estate background, someone who has a Wall Street background, or someone who's just a master networker?
I think it just depends, for each one of those groups that you mentioned. Each one of the things that's really important, what I focus on is alignment with the person I'm talking to. Like, I want to make sure that we know where they are, and I know um, who they are and where they are in their life to make sure that we're the right fit together. Because if we're not, then it won't really gel. I'm not really looking out for their best interest. If I'm not in alignment, like say if they're not used to multifamily and everything like that, there's no reason for me to really be. I can talk to them about it, but they need to be educated and understand what they're getting into. But if I keep telling them about it and try to get them into it, it's really kind of a misalignment. I'm not really looking out for their best interest. You know, it also really depends on where they are in life because it's really about what they need, for their long-term success.
So for folks who are, in the middle of trying to figure out which direction to go in, what would you recommend for folks who are diving in trying to raise capital as far as a starting approach?
Starting approach, you really want to, make sure you know who you're talking to. and make sure who your target audience is, especially with the asset that you're dealing with. Make sure you have an alignment of interest with whoever you're talking to, whether it's friends and family, institutional capital. What's their overall goals? It's not about, sure, you might have a great deal, but it might not be a great deal for Dylan. Dylan might be looking at, private credit. I'm getting near retirement. I just want, my 6, 8, 10%, paid out every month. I don't necessarily care too much about the long term, 25% IRR or whatever, or, you know, the long equity pop at the end. I may just need the cash flow.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Yeah. I mean, when people talk about goals, I think over the last 10 or so years, things have changed drastically, right? And time horizons have adjusted as well. In the deals that you're raising capital for, what's a typical hold time, or does it vary deal by deal?
Generally, what we focus on is a 7% yield on cost, and then the equity multiple, 2x multiple, in roughly 5 years, or longer, hopefully less, but 5 years is usually our target. We've done some things that have, come in less than that, but which is great, but that's generally our target because, 2x multiple in 5 years is doable, even in today's environment.
Now, when folks are looking at working with, institutional capital, family offices, accredited investors, once you have a successful capital raise with one firm or with one family office, with one accredited investor, does that tend to spawn additional relationships, or is, each outreach, just as challenging as the first one?
Well, it's all situational, but it gets better because, as you gain more confidence, and also as your deals get better and your overall systems get better, you would hope that you're growing into, better situations where it makes it better for the investors and, you know, family offices, institutional capital, credit investors. All those are three uniquely different things. And in each one of those segments, each one of them has a different, thing that they're looking for. And you generally want to solve a problem that they're looking for, what type of investment or property that they're looking for. It's not about really what your deal is or what works best for you. You're looking to fill a need for them.
Once capital has been raised and deployed, I mean, to me, and I think a lot of people who are on the outside looking in, that's when, a whole other segment of this comes into play where now you've got to keep investors happy. You've got to keep them engaged, and you got to help make sure that everyone understands, what their money is doing and going to work for, because it's going to be 5 years, like you mentioned, until the exit happens. So what's communication like with investors along those 5 years?
Well, we have, monthly newsletters. We have updated meetings that we do, webinars, ongoing continuing education about what we're doing, market analysis, stuff like that. And then overall, a lot of times for me, I like to pick up the phone every so often, a minimum once a quarter or so, check back in with people. But depending on the person and what we're actually working on and on the project, um, I like to over communicate, good, bad, or indifferent. Things need to be communicated. They need to know where they stand. You need to know, they need to know that, you are doing what you do, um, to help them along their journey and make sure that they're involved with what, because it's, it is their hard-earned capital. You want to make sure that you're bringing your expertise and letting them know that everything is safe and you're doing the best for them.
Now, when we talk about raising capital for development projects, there's so much that can change because from the start of a development project until completion could be, months, could be years potentially, and markets change, global political dynamics change, and so there's a lot of unknown there. As someone who's raising capital, what's your tie in with the development team, and what are those communications typically like between the folks who are managing the development side of things and the capital raising?
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Well, we have, weekly meetings, and all, big picture stuff, smaller segmented ones that are, deal specific or asset specific, also to keep everyone informed of what's going on. And we all always put in contingencies and we communicate all of those things to the people that we're actively partnering with. Because I don't call an investor, I'm more calling a partner because they're partnering with us, because they have a certain level of trust with us. Because, they're a limited partner. And just because they're a limited partner, it's not they give us their hard-earned funds and then we walk away and we see in 5 years. It's an ongoing process. We like people to learn the process with us, of how that deal is going, to where we're a continuing base for education, so they understand that this is a viable um, asset for them to invest into, and also that we're a viable group that is very consistent and very conservative and stable. We focus on stable developments that you know could be benefit to them. If that's something that falls in line with their risk profile, because there is risk associated with it, and we just want to be clear that those are there is, with everything there's inherent risk.
What do you see as being the biggest differences in skill sets between the person who's raising capital and excellent at that, and someone who's great at managing projects and crews and subcontractors?
The Each of them takes a unique skill set. Both of them involve people, because all of this is a relationship business. It's all people. It's all about building the long-term relationships. We don't get involved with anyone that's where it's just transactional, one and done. We want to build that relationship for long term. And on the more operational side, because as a captain, I've done that for many years. It's more of a direct relationship where you get a lot more yes, no answers and a lot more guidance in that way. But in the capital raising side, it's more of a sales approach where it's more person specific, and deal specific. We're dealing with this specific person. Not to say that doesn't go on in the operational side, but each person in the operational side has a specific job, and each task is very task oriented. Whereas with the capital raising side, you're more dealing with the different personalities and different long term assessment of what that person is. And you're going to grow with that person. Whereas, granted, the operation side is going to grow as well, but each job and each one of those jobs is going to be fairly similar. You're going to set up the systems to where it's the same every time. Whereas on the capital raising side, you can't think that you can have the same conversation with every single um, partner or investor. It has to fit with what with what they're looking for.
Do you think realistically, folks can be both strong developers and capital raisers? Do you think, for the most part, people have to pick one or the other because it's almost two different entities?
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
I think you can be good at both. I mean, if you're a very strong developer and you have a very strong track record and you've done well as a steward for people and performed well over the years, generally you don't have a problem raising capital because your track record speaks for itself.
Yeah. I mean, when we think
Happens all
about,
the time. It's not an automatic. It's not an automatic. Either one of those. You know.
when we think about some of the bottlenecks that people face, and I'll say it again, this raising capital thing seems to be the most common bottleneck that I see people face at multiple segments of real estate. They might be doing a lot of flips, right? And we're not talking about multifamily. It just might be single family flips, and they realize, hey, we're going to need more capital, right? Capital becomes a bottleneck for folks in multifamily. Of course, you're constrained by how much money you can put down to qualify for loans and bigger projects and etc. When you're talking with newer developers and newer capital raisers, what's the biggest mistake that you see people making?
They treat it like a transaction. They don't look at it long term as, this is all relationship business. I personally only want to get involved with people that want to get involved with me, and we have aligned interests, and we're doing that this for the long term. It's not a one and done. We're in it for the long haul. We want long term partners to where, hey, we're dealing with John. He likes, he likes hospitality, and he loves what we did in the fund with that one.
Do you see developers get stuck in projects because they're focused on things like capital allocation and how they're going to raise capital, or typically are they already have that side of the business handled when they're working on projects?
I think it depends. It depends on their track record. If they've been doing it for a long time, a lot of times they have those systems in place. It happens. I see it quite a bit with myself and others. Like when you're growing, you have those growing pains. Where you're going to need more capital, or you need more deals, or you need more different systems. Because as you grow, you might have, if you're dealing with a 100-unit property portfolio, it's much different than dealing with 1,000-unit portfolio or a 10,000-unit portfolio, because
Yeah.
you're going to need more people. You need more systems in place and everything that you know that that you have to grow with. And whenever you're going to the next level, it's a little more. You might not know what you actually need because you're not there yet.
We were talking in the green room about a deal that you were raising capital for in Texas. I know that you're based out of Florida, but you do a lot of traveling. So looking at deals all over the country. Now, the Sun Belt is very hot, it seems, but there's also some risk because everyone's looking at the Sun Belt. Some people may say, overdeveloped. When you're evaluating deals anywhere, are there any major red flags that you would just say, hey, I'm not going to touch this?
Well, we mostly are focused with the multifamilies and residential, is in Texas, in that Texas Triangle, I-35 corridor, Austin up to Dallas specifically. So within each market, you're going to have, in each metro area, you're going to have multiple different markets in there. Like Austin, as we were discussing before, and San Marcos and stuff like that. they're giving huge concessions, which means probably means that there's a lot of product that just came online and it needs to be absorbed. So something like that, we're probably going to stay out of because, you know, it just means that there's probably going to be a little while before all that stuff gets absorbed. So that's why we're focusing on the northern part of, the southern part of Dallas where it's less competitive, less, where there's infill lots where there are smaller boutique style multifamily where, there's less competition. Like on the north side of Dallas, they're building
Yeah.
huge amounts of multifamily and it's very competitive. Land is more expensive. That's why we're carving out that niche there for us. And, we don't necessarily, right now, we're looking in the Dallas Fort Worth area or in Kansas City with our medical office and surgical centers, looking to bring the medical products into um, other areas. We're area agnostic, Florida especially, and Texas, because those are unique because they're all pre-leased by the surgical group that we partner with. It's not necessarily location specific, other than it needs to be close to a hospital so that and the surgical group usually they understand all those demographics as far as what the needs are. We basically build the shell and partner with them and show them how that they can benefit from the real estate. They can build out their business and build the real estate and benefit from both.
So you're developing for the medical space. I think
Yeah.
that when we talk about some of the niche areas that people are getting into, I haven't spoken with too many folks who are doing, medical office. But of course, it's a huge need and ever expanding. For folks who may be looking at, which asset class to get into, and they're looking at, retail, maybe medical, maybe multifamily, right? And they're trying to figure out, well, what works for them. Do you think it takes a certain type of, persona to be a successful operator in each segment, or is it really just does the deal pen or not?
It's a little bit of both because I know a lot of like with the medical offices, we've had luck with speaking to a lot of doctors and surgical partners because they understand that side of the business already, and multifamily, a lot of people understand that along with, as a step up from, single family and stuff because we've all lived in an apartment at some point. A lot of us have. We understand that people have to pay to live somewhere, retail and stuff. We understand the small mom and pop stuff. We understand we buy stuff from those places all the time. We frequent a lot of the same local establishments. It's all kind of depends on your personality and stuff. Some won't touch, multifamily. Some won't touch medical office. But it all depends on what you understand and what you're educated about. I think each to each his own. There's no one thing, one size fits all for anyone. I would think it's more up to the individual and their experience.
We are coming up on time here, Scott. Any new projects that you're working on these days?
We are working on a hospitality project in Chesterfield area of this is the St. Louis MSA. It's a very affluent area of St. Louis, and it's a baseball themed hotel. We are working on a licensing agreement with a that's not um, quite all the way there yet, but it's pretty close. But the idea being is that we already have the land allotted there, along with 206 multifamily units and 40 luxury condos, 200 key hotel. There'll be Chesterfield Mall project, and it's very unique because we want to take this and eventually do it in every Major League Baseball market. So it will morph into quite a large project because there are 32 major, baseball markets and some other smaller segmented ones that could be a good fit for these baseball themed type hotels. But not every market is going to be, robust enough to really carry one of these hotels. But it could be. It has a lot of potential, and that's our that's something we're really excited about, and I am really excited about because everybody loves baseball.
Scott, thank you so much for joining us today. Thanks for taking the time.
Oh well, thank you so much again. I'm sure I'll be back for a fourth time.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.